Hi, people. Thank you for stopping by at Building Wealth with Rajiv. A couple of weeks ago, I had a chat with Pradeep Bonde, one of the leading traders in the US, on how he's navigating through this choppy market. Just now, I had a very good chat with two very promising investors, long-term investors, Max Koh and Eugene. Eugene has written a book called Vision Investing. Great book. Please check it out. Max is not even 30, but he's financially free and a very successful investor. We talked about how they're managing through these drawdowns. What is their strategy going forward when Fed is going to hike rates at least 5 times in the coming years? How they select companies, what companies are they most excited about as the earnings season comes. Max, Eugene, thank you so much for giving me time. And you guys both are so young, but both so successful in your own rights. And it's always good to listen from such young, successful people on what's happening in the stock markets. So tell me, what do you make out of stock markets these days? Eugene, you can start, or Max, anybody can start.
Yeah, Eugene can go ahead first.
All right, thanks a lot, Rajiv, and it's good connecting always with you and Max as well. I think in terms of the stock market, I think we really got to know, firstly, is that market drawdowns will always happen. Price volatility, it's always going to be the name of the game. The only question is when and how much. I think on average, you know that the market probably draws down 10% probably every year or so, 15%, 20% every 2 to 3 years, and 40 to 30% or 30 to 40% every 4 to 5 years. It's very, very common. It will keep coming, and it's just part of it. I think the way I always go back to this recurring theme is one of my favorites quote by Ben Graham, which is the stock market in the very short term, it's really a voting machine, and the stock market in the very long term is a weighing machine. And all I think about it is that the price movements are just mark to market on every second, every hour, every day, every week. But businesses really just report 4 times a year, really. So I think really you just got to disassociate the market movements, the price movements versus the business movements. I think that's extremely crucial. And of course, I'm not happy, right? I mean, my portfolio is down quite a fair bit, obviously from the highs. But I think the way to think about it is that has there been anything wrong since last 1 month, 2 months ago, right? I mean, the majority of my companies, for example, I just did my own annual letter that I just wrote up. The revenues were growing 40% year on year. I'm like, they were growing 40% year on year, and the stock price is down 50%. I mean, is there something wrong, right? I have no idea, but I'm very happy, and all I see that this decline is a market opportunity for me to buy even more for a lot of the companies that I have always liked, and I bought a fair bit of it, about 2 days ago, and if the market draws down some more, I'll be more than happy to keep adding positions, and that's just how I think about it. I mean, I'll add to my highest positions. And just keep adding it up. I think that's really just how the way I like to think about it.
And what's your view, Max? You're
smiling. First thing is, I just want to ask,
man.
like, where Eugene gets so much cash to keep adding and adding, which we should talk about later in terms of like cash position, right? Because I can't swear here, but I'm out of cash, man. So wonder where he gets his cash unlimited supply here. But anyway, I think Eugene kind of nailed it in terms of like market. How you should view the market. I think for me, I'll speak from a personal level. I'm actually okay in this period. So I know it sounds hard to believe, but I'm not really panicking. And I think for me, it's because of one thing. It's like, when I started investing, I was very lucky to, I think, chance upon Buffett and Munger and Lee Lu, what have you, all the correct people to learn from at the very beginning. So I think that helped shape my lens in terms of, at the end of the day, which we all have heard on Twitter, like I think Buffett says it's like the gospel, you are a freaking owner. And I think the thing that allows me to really dissociate is, at the end of the day, if you think about it, when you really buy a business, is there really such a thing as a stock price? Assuming you buy a business that's not publicly listed, there's no such thing as a stock price, which is something that I always ask myself today when I'm like trying to reflect on these crazy times, right? If today this stock market, this shit didn't exist, pardon me, this stock market didn't exist, would people be reacting the way we are now if you cannot see the mark-to-market movements of that tape or that ticker on the screen? People probably won't react the way they react now. So then it got me thinking, actually, it is a very, very just human psychology being driven by the price, which during peacetime and during like the bullish times, you can hear people say, all sorts of things like, oh yes, never ever let Mr. Market be your director. Instead, you should always like, let it be your servant. But we can say that easily off our tongue. But now you see people, I think Eugene, I think we kind of chatted about this as well, like the WhatsApp group or something, like people are changing the thesis because the price is moving. So that's when you see a lot of stupid behavior, pardon me. So I think for me, how I'm seeing this is I'm actually quite zen, quite neutral, because at the end of the day, like Eugene mentioned, there is nothing wrong with the business. Like he mentioned, the business on average, was it you mentioned 40%, right, Eugene, for on average of businesses? So yeah, I mean, the revenue growth is there, and so the price and the business, the fundamentals are now dislodged, right? So they are not exactly tracking well with each other. So I think it's very important to step back and sometimes ask yourself, actually, the price, does it really mean something, or is it just something that's just based on demand and supply? So yeah, that's how I see it.
Oh, I think, look, this is good. Well, one thing I want to know from both of you, I think you guys are pretty, active investor in the sense of reading. I think not in terms of buying, selling, because you guys read a lot. Like Eugene has written a book, and Max, you're always on.
Eugene reads more. I swear to God, like, this guy is insane. Like, yeah, okay. He's nuts.
So you're an active investor in terms of reading, but did you think that the correction will be so harsh? Well, it's a very hard look. If you look at index, if you look at NASDAQ or S&P, the big boys have saved them. Apple or the Teslas of the world. But if you look at the typical growth stock like C Limited, or if you look at Roku, I mean, it's blood on the street. It's like 50% down. I mean, did you expect that it's going to go so fast?
Yeah, of course. Totally saw it coming. No, just joking. Just joking. Completely didn't see. I think I'll just share a bit first, right? So I think for me, totally didn't see it coming. And I think the reason, of course, same thing. While I'm okay, zen with it, I think I'm pretty surprised in the sense that, because I think even though, Rajiv, you mentioned, I've been investing longer than you, but definitely it's still, I would say, very young investor myself, only 3 to 4 years track record. And so I think the reason this time, you use C Limited and Roku as an example, but there are a lot of other growth stocks as well. Look at Fiverr, take any hyper growth stock, without proper free cash flow, would have been hit pretty badly for most of them. And you realize that this time, I think the drawdown is more painful as compared to COVID, even though the COVID lows of the S&P, it's actually lower. So I was just looking at this morning, I forgot the actual numbers, but the COVID drawdown was much more than the current drawdown. But the reason it's more, or it seems more painful now from what I see on FinTwit, the sentiment, is because this is a more elongated drawdown. I think Eugene can elaborate more because he has a lot of charts that he normally likes to look at in terms of the historical patterns, right? So even though it's not as deep yet, hopefully we don't go that deep, but it's more elongated as compared to that V-shaped bounce that we experienced in March 2020, right? So I think because of that, a lot of investors were not expecting it to be that long, given how bullish we were in 2020 and almost the whole of 2021 till November or December when this thing hit. So yeah, that's actually my take of how it's happening and how investors are reacting.
Yeah, I mean, I echo a lot of what Max is saying. I think in terms of the price declines, I think the way to think about it really, I think whenever you hit all-time highs, or let me put it this way, markets exit at all-time highs probably about 5% of the time. So actually, if you think about it, majority of the time, almost 99% of the time, we are actually trading below all-time highs. So if you're not comfortable losing, you should not be investing. I think that's really extremely key. And the way to think about it is that a lot of the companies that we are investing are typically higher growth companies, and they're also growing, very, very, very profitable, right? And sometimes they are trading at tend to be trading at a higher beta or a higher what we call sensitivity to the market. So if the market is, for example, going up by 1%, the stocks could be going up by 2%, 3%. And of course, if the market goes down by 1%, they will go down by more, at 2%, 3%. So obviously, the S&P has gone down maybe 7-8% off the highs. A lot of the stocks have come off. And I think where the market has done is to differentiate a lot of the more profitable ones versus the not so profitable ones. I think that is what they have kind of done, that differentiation. And I guess it's also about the narrative, right? So they have differentiated the big boys, and some of the guys have been more evident and more clear. And I think where they're questioning is the moat really still there? Is it really durable? Are this really just one of COVID beneficiaries, and after post the COVID beneficiaries have not, right? I think the way to think about it is a lot of so you can just try to go back like say 1 year plus ago, right? A lot of the companies throughout their entire 1 year, the non-growth tech companies have suffered tremendously. Their year-on-year growth rates were massively negative, down 50, 60, 70%. And now, if you look at the year-on-year effects, actually, based on Q4, right, they are still growing, and they're probably growing 30, 40, 50%, right? Even you look at the oil stocks, right? Oil prices 1 year ago were at all-time lows. So a lot of these companies are still experiencing very high base effects due to year-on-year growth rates. And the market likes growth. They like fast growth. So a lot of the money is just going to where all these companies are, right? And the way I'm thinking is this, right? The guidance is going to come at some stage when they start guiding back to the original low single-digit growth numbers, and whereas our companies are still going to be growing at normal rates when they start normalizing, and that's where the fund flows come back. I might be totally wrong on this, but I think the market is very fickle in the very short term. It goes where it wants to go, and eventually we just got to be very steady investors holding our businesses, because if you're trying to time the market, just to give an example, right? If I want to sell, I could sell my companies and buy another company, and then sell that company and buy back my company. And just to think about it from that perspective, right? First, I have to sell my company at the highs, I have to buy that company at the low, I have to resell back the company perfectly at the high, and I have to rebuy back my company at the low. It is almost impossible. If you try to even give it like 60% of each probability, you do it like to the power of 4, it's like 13% probability. So you get 13% probability of trying to even do these 4 things right for one stock. You have a 10 stock portfolio, is insane. It's almost impossible. You literally not get it right? And you have seen so many charts. If you just miss the best days alone, your returns will just massively deteriorate by very significantly. I think that's the way I do it. I mean, these drawdowns are not common. I mean, I would say it's not common, but I've seen it before. In 2018, it was just as bad, right? A lot of the growth stocks were down 40, 50%. I had experienced exactly the same thing. So to me, it's like, it rhymes, but it's not exactly the same. So I think that's always how I...
So what happened in 2018? The stocks came back to their original pricing. They reached back to their all-time highs again.
Yeah, I think in 2018, I remember it was a horrible year for me as well. And then
I recall Tesla, that it was December, right? The December period.
Exactly, the December drawdown. Like you had a great year, and then suddenly one December.
Suddenly, end of the year.
You're massively just down. And that happened. And then suddenly you just held it. And 2019, of course, it went back up, it recovered back. And then, of course, you had 2020. And I think really it's just focusing, holding the companies. The way I think about it is this, right? For example, if my company's average revenue growth rates are growing at 40%, I know there's operating leverage, they're improving their profitability. Like the free cash flow margins, say, for example, around 15%. Free cash flows are growing faster than revenues because I know the free cash flow margins are rising. So I know intrinsic value of my portfolio is growing 40 to 50%, right? Though my multiples might glide down over time, I should be able to expect a certain decent amount of returns. That's how I really just think about it broadly from a portfolio management approach. And I know that, I think just think about intrinsic value. Is my portfolio growing value? If it's not growing value, then it probably will come off. So I think just really stay focused on that and really just ignore the noise.
Actually, I want to just talk on that last point, right? I think it's a very solid point, and that's also why I think valuations, as much as it's not the be all end all, the business quality still comes first. You have to have a rough estimate of the intrinsic value of each of your companies that you own. Roughly, I mean, it's not like a fixed number. And the reason I feel there's so much panic, it's because people buy in purely based on the growth or the hype. These are quality companies, which is correct, nothing wrong. But you don't have a proper measure of what is the intrinsic value of the business, which is why they're shitting their pants now. Like, for example, let's say like C Limited. Let's use the example that you mentioned just now, or like Roku. But let's use C Limited, right? Because I own it. And so like it's currently, how much is it? Like $140. But if you do your own valuations, of course, 3 of us will come up with a slightly different number. But based on your own valuation metrics, it's definitely not $140. And then like, I can't really pronounce his name correctly. Was it Michael Mabussain or something? Like there's this thing called expectations investing, right? So based on the stock price that the market is giving you now, you want to ask yourself what kinds of assumptions are they pricing in to that stock price. So at C Limited at $140, if you use, let's say, certain metrics like the growth and certain implied, adjusted, maybe more steady state free cash flow, even though they are still burning cash flow and so forth, and then or use like a GMV multiple just for that example, may not have to be C Limited, you arrive at a certain intrinsic value for some of these companies that makes you realize actually it's completely dislodged. And I think to give the best example right now, I'm not sure whether it's still at the same number. I think a very good example is you look at the current sentiment as we're talking today, like 26 January 2022. You look at like Zoom technology, which is this platform that we're using now. Zoom video technologies price to free cash flow multiple. I recall, I think I was looking at it just a few days back, it was like what, 25, 27 times. And then you look at P&G, Procter and Gamble, or was it like Walmart, Coca-Cola, some of these more traditional businesses, it's also priced at like 20 plus price to free cash flow. So the market is saying that they are valuing in terms of the multiple, like a Coke or a P&G, Procter and Gamble with a Zoom, who is a recurring business with, I believe, 130% dollar-based net retention, like every single year, and it's still a sticky software business. That's kind of like having a huge user base. So just when you look at things like that, you kind of realize, okay, maybe it's not wise to be taking too much instruction from the market at this period, because sometimes when stocks drop, maybe there's a valid reason. But when you see such a thing in the market, you got to realize, maybe Mr. Market is indeed kind of drunk after all. So yeah, sorry to kind of steal the thunder. Yeah.
No, I think very useful example. Now, this brings me to a very important question. I think I've had some chats with Eugene, but I always wanted to pick his brains on this valuation part, because valuation is subjective and it's very controversial, right? I mean, there are 1,000 matrices going around. So, and I kind of Max on the same boat of you, of having a loose idea of the intrinsic value, a range. It's important. You want to buy something, you want to have a range, right? It's a house or it's property or whatever. You got to have budget, you got to have range, right? It's sensible. How do you guys talk about? How do you guys think in terms of intrinsic value? I mean, Eugene, you want to talk, and then Max, you can take an example of C Limited and say. So what's like, Eugene? I know the quality of business, the starting point, and all that. Without that, there's nothing. But when you come to intrinsic value, where do you? What works for you?
When I think about intrinsic value, I try to understand what the business is, right? I think trying to understand really how deep the moat is, how recurring the revenues are, and just give an example of Zoom and just try to elaborate a little bit more on Zoom. I think Zoom's retention rate are probably north of 130%, right? All they need to grow, if they can grow customers say at 10%, the revenue top line is going to grow at 40%.
Yeah.
Right. Yep. Exactly. So and we know that the majority of their revenue is all recurring. So I think so it's extremely sticky. And if I guess the way to think about it, if there's a structural decline, we will know it quite quickly because the retention rates will fall off the roof, the orders will come off, the billings will fall off the roof, and you will just be in about 2 to 3, 4 quarters, you will know it immediately. So I think those are very quick telltale signs. Now, but structurally underlying, the business is perfectly fine, right? And if you look at it from the standpoint. So if you think about it from Zoom, so how the way I think about in terms of valuations, I usually take, for example, the trailing 12 months revenue. I try to think about in 3 to 5 year terms at least. And then I try to compound with a growth rate. So for example, I think Zoom, ideally, if they can grow 20% customer growth, they should get 50, but if I be reasonable, right? Maybe grow at 40. I know their free cash flow margins are around 25, 30% even, or even higher actually. And then I would assume a certain reasonable market cap to free cash flow multiple. Okay. And then I'll apply that and I'll get myself a kind of a range versus the current stock price. And I'll balance that and see, okay, is that a minimum CAGR? Does it meet my minimum CAGR of 25%? And if it does, I'll invest. So typically that would be at least a 3 to 5x in 3 to 5 years. All right. So I think that, so value of free cash flow being one of the criteria and the cumulative growth rate of about 25%, those the factor in for you to make a decision. And then, okay. And what works for you, Max?
Actually, it's very similar. So it's kind of like a IRR kind of calculation. So same, I'll see what's assume the growth rate I want to assign to this company, like 3-5 years out. I normally use 5 years, and then based off that, by that time, what is the adjusted cash flow that I think that business can expect based on how they are currently innovating or executing. And then, of course, for me, I will also factor in. So I think this one Eugene didn't touch on, but for me, I do this because I'm a bit more conservative. I'll also factor in the current like fully diluted shares, and I'll also use a certain dilution percentage after 5 years. So then I'll take that that free cash flow, I'll give it a multiple, and then I get the market cap in 5 years, and then I divide by that fully diluted shares at that point in time, and then I look at the stock price now and stock price then, and then I'll calculate IRR for me as well. So similarly, IRR is 25% as well, so that hoping to double the money in 3 years kind of percentage. To be fair, it should be 26%. So very similar like way we invest as well.
Max, Eugene Max indirectly just told us that he's more clever than you. Is fun.
I'm more conservative. I'm more conservative.
His model is more robust than Eugene's model.
Anyway. Take that vision investing. Just joking.
Okay, so I think that is good to know. But let me just come to your investing styles. I think I know I've talked to both of you and kind of have an idea. Max, is there a time you regret your concentrated portfolio?
Yeah, actually, I wanted to share something, right? So it's something that, so funny enough, just a quick funny backstory. So I don't know whether it's related or not. During this period, I've been meditating more. I think to kind of find more inner peace.
You look like a monk.
Okay, so anyway, I think as I'm like, doing more reflections or internal evaluations, and I realized I just had this kind of like an aha moment, and I'll come to the portfolio concentration question you asked. But I realized that in this period, a lot of investors on Twitter or like on the net, they talk about, have faith, have confidence, have conviction in your holdings. And then I came to this realization, actually, what does this confidence, conviction, it's a very easy word that you can just throw out there, which investors on Twitter, a lot of gurus on Twitter are all saying, but what does it mean? And I realized actually this confidence or conviction, if you break it down further, it can come from two ways. The first way is it comes from you knowing the hell out of what your company is doing very, very well, or it can come from a structural way in terms of how you allocate your portfolio, which I think this one Eugene can talk about more. So for me, I'm very concentrated. So I have, just to give some disclosure, I have about like 7 or 8 positions, but I think the top 4 make up like 80% of my portfolio. So yes, it's hyper concentrated, I think. And so obviously for me, I just gave two factors, right? The second way that I just mentioned, which is a structural way to gain confidence, I can't get confidence there because of the fact that I'm super concentrated. So what I mean by structure is in the sense where, let's say, if somebody has a portfolio of like 50, 60 stocks, even though, yes, the market is drawing down, but you're not hit that value across the board on every single stock. So there's still some variation. So that allows you to kind of still not get emotionally affected by the stock price, even though I think on the surface you'll still get hit mostly, but not as bad as a concentrated portfolio. So in other words, what I'm saying is that structurally, your diversification or you having a certain cash position gives you a structural kind of confidence in being able to hold, right? Whereas for me, I don't have that. So I have to derive my confidence from knowing the positions that I own really, really well. So example, me being invested in the companies that I follow after every single quarter, looking at the earnings calls, reading the transcripts, what have you, and like really watching the management interviews, that's where I derive the confidence from. And then I think a way that I still continue to derive confidence is really the intrinsic value, like Eugene mentioned. Just every time as the market drops down further, and I normally don't check stock prices on the weekdays, thankfully, so I do it on the weekends. Let's say I wake up on a Saturday, which I did like 3 days back Saturday, right? I just woke up and then like, holy shit, like C Limited is like $150. Like started the week at like, I think 190 or something. I didn't expect it to drop so much.
I bought it at 90.
So I still had to refresh my screen. I thought maybe Interactive Broker, Saturday morning, they're doing maintenance, right? Normally I thought, okay, maybe they have error. So I went to Google to check. I'm like, holy fuck. Okay, so anyway, okay, fine. So the market give it to me. Okay, Max, take this US, like, okay, $150, right? So then I asked myself, $150, what is it assuming? So let's say I pare down my assumptions even more. I assume that, let's say, the market prices, so we're going a bit deeper here, if I may, like, okay, Garena at, let's say, like a multiple of like 12 times, because yeah, it's slowing down, even though I previously assumed like a 15 times multiple, but okay, I assume 12 times. I assume that Shopee's price to GMV multiple, which I assumed 1 time previously, okay, I pare it down to like 0.8, 0.7, and I make the growth rate even slower. Even then, I cannot get to $140, $150. And so that's when, I double check, triple check the math with an even more conservative assumption, and then you realize actually, it still doesn't make sense. And then that allows you kind of go back to sleep better. So that's my point, right? So of course, in order to do such valuations, you have to have a very firm grasp of the company. And so that's why I think for me, to answer your question, Like, is this concentration something that I regret? I would say it's given me a bit to think about in terms of maybe I should not be so crazily diversified after this. So maybe I might take some tips from Eugene, Vision Capital. But I think for me, I'm still okay because of the fact that the companies that I invest in, I know really well, and the companies that I don't really know, I just don't touch. So yeah, that's me.
And Eugene, what makes you so diversified? I think you have like 40, 50 companies, right? I know you have a lot of money, but 40, 50 companies.
I think the way to think about it, as also in my book, I think the minimum any investor should have in his portfolio should be around 20 to 25 stocks. That's why I think should at least diversify away some of the market risk and really focus on the business risk. So for me, in my portfolio right now, I have 85 companies. But interestingly, the top 20 positions is about 70% of the portfolio.
Yeah,
The top 30 positions is about 80% of the portfolio, and the top 40 positions is actually 90% of the portfolio. So actually what happens is that slightly different versus a very concentrated portfolio is that because it is diversified in that sense, the winners can actually run, and I've let my winners run massively. And because they can run so massively, they can become so big, I never needed to trim them and to basically cut my winners and to allocate to my next second best winner or my third best winner or my fourth best winner. So I could always have that capacity to let them run and to let them prove their worth, right? That they deserve to be as big a position as they are. And I think that's the way to think about it, because the way I structure my portfolio is when you're long a stock, there is a limited downside because the maximum a company can go down is minus 100%. Basically, you get everything down to zero. And if you're finding the right companies that can be able to compound for the long term, the upside is really infinitely unlimited. So the way to think about it is that I structure my portfolio as literally a strip of call options. The way I think about it, it's just I'm paying zero premiums. And the way how to think about it is like my biggest single winner is more than 10 times all of my losers combined, the losses from all my losers combined, right? And that's exactly what it has been. And it's only going to be more and more skewed with time if I get it right and I allow that to happen. So I think that's how I have done it over time. And the way sometimes I have started positions, and if the started positions don't work out, I exited them. Like for example, even last year, I exited close to 11 positions, right? And these 11 positions which I exited, which I never added to them even after right from the beginning, amounted to almost 1% of the portfolio. So because they were losers, I've never added to them. And even though when I sold them, they were actually became meaningful, right? So what I'm trying to tell you is that the winners become more relevant in kind of my style of investing, and the losers just became less irrelevant. And that allows me to sleep very well. Let's say I have very big concentrated traded positions. My top position is more than 10% of the portfolio. So it can be extremely concentrated as well. So it's really just a different approach. I think it's really it depends. I think really it's just different. Everybody's playing a different game, but I think most importantly, they must know that game, must be able to suit the mentality. I know that, for example, with this style of investing, the portfolio size can go up to easily 100 million, 1 billion, 10 billion because of the style of investing, right? I'm investing in bigger companies, I'm investing in more. So I design my strategy to be kind of everlasting, design it to be very scalable, regardless of portfolio size. I want to make sure I start the basics right from the beginning. And even though if the portfolio is 10 times bigger, 100 times bigger, I can still use exactly the same style without compromising or having to change. And that's why I also don't invest in small caps as well, because if the portfolio gets too big, I won't be able to invest in the small caps. And then what I have formed my own competitive advantage in investing in small caps would then not be applicable. So I think really I try to think about it, really what the long term is, and try to kind of make sure that the strategy is right all the way from the beginning and allows me to sleep very well.
I think, makes sense. I guess what suits your personality is very important. Otherwise, your value system, your personality, and what do you think about the companies and all that is pretty important.
Yeah.
Your view, Max?
For me, it's just ownership mentality, back to basics, right? If today I own the business, let's say I really own the whole of C Limited or the whole of Roku or the whole of whatever Zoom, whatever business we just talked about. And then I realize, Jerome Powell is going to, raise the interest rates. Well, am I going to sell the whole business tomorrow, list it on some online auction and sell it away? Then, okay, I wash my hands. I'm not going to do that, right? So yeah, end of story. So the only thing it affects is my discounted cash flow, which is why all the analysts' price targets all drop, which is understandable. But that's just what the analysts are playing, and I'm not in that game. So yeah, as an owner, I don't sell the business because Jerome Powell or whoever is going to like raise the interest rates, whatever. Yeah, end of story.
But your CAGR is going to be affected, isn't it?
Yeah.
Your CAGR expectation of 25%. There is a value compression, isn't it?
Yeah, correct. So good question, right? So I would say yes, there is value compression, but I mean, you just have to kind of realize that even if it compresses my value of my IRR in 5 years, but if this is a business that I think can execute beyond just 5 years, then okay, just because this IRR amount, it's something that's also based on my own calculations here and so on and so forth. So whether I use a 5 years, 10 years, that will still have a very different number for different people. So yeah.
I think that's a good one, but you don't believe in rotation. I mean, look, we see the rotation, right? Value rotation to growth rotation, growth to, so you find something which is, obviously it's what price is what you pay and value is what you get. But when these value compressions happening, doesn't that change any scenario for you in terms of your investment decision making?
I would say short term, yes, that you can rotate, right? But it's the same thing that I think Eugene mentioned very beautifully just now, right? And I just so happened to be reading the annual letters of Terry Smith just a few days back, right? Fund Smith. So he said, which is the recent letter he just released like last week or 2 weeks back. He said the exact same thing. And you can rotate now and maybe earn a few points of alpha from that, what have you. But then after the rotation, what you're going to do? You're going to rotate back. So I think Eugene mentioned just now in a very nice way, right? So you have to know when to sell, then you know when to add back. Then after the thing rise, you got to sell, then you add back, you rotate back to something else. So you got to balance a lot of decisions, right? And I think, especially as long-term investors, there's this term that's very crucial, and that is this thing called reinvestment risk. And that is, I think I would say I'm humble enough to know that the more decisions I make, the more I'm going to screw it up. Right? So I just want to be in the situation where I make the least amount of decisions possible. So these companies that I'm in, I think they're good companies. The management, I like them, right? I think like the Vision Capital, the Motley Fool, I'm wearing the shirt or the jersey of the company that I support. So I like these companies. So let's just own them and not value rotate. Even though, to be fair, I'm not saying this strategy I just mentioned is superior. I know people who rotate along. I think you mentioned a few investors on Twitter do that, and maybe can do that well. But I just think it's not my personality. I don't like to think about these kinds of stuff. And so I'd rather not play that game to begin with because it's not my strength. Yeah.
Okay. I think Eugene obviously doesn't believe in it. I mean, he's very, very fanatic about his businesses and he researches them and he sticks to them. Now, you talked about reflection, Max. Eugene didn't seem to have much reflection, so only you and me. So,
just kidding.
So one thing, I looked at index returns. I looked at NASDAQ and I looked at from 2011 to 2020 NASDAQ. Now, if you invest in NASDAQ, roughly 7 times, you make 7 times your money, right? I mean, that's NASDAQ returns. I mean, obviously, 2020 heightened it. Now, when I look at that, I say that you're investing in 100 best companies of the world, of US technology companies, and you're multiplying your money 7 times in 10 years. Then why take this hassle of reading through so many annual reports, these books, magazines? I'm still investing in companies because I like reading about them and all that. But it's 7 times. It's no joke.
I have an answer to that, but usually you want to go first. Yeah.
Max, go first, please.
Oh, okay, sure. Okay, so here's my take, right? And that is, I fully agree with you. In an ideal world, right? I think to answer Reggie's question. So to me, actually, this is not so much an investing question. It's more like a personality question, I feel, but that's my perspective, right? So in the ideal world, if returns and I'm trying to optimize for minimal effort or time returns, whatever, then I might just do a dollar DCA into either the NASDAQ or the S&P. But to me, I firmly believe, and I came across this Twitter account, I forgot who was it, that also said something similar to this. At the end of the day, if you're only investing for returns, then yeah, just go for that. Like, and when I say returns, something about like returns versus amount of time you invest in. But to me, like picking individual stocks is just a way for you to learn and understand more about the world, right? To become smarter and you feel better about yourself. So maybe after 10, 20 years, for some reason, I still fail to beat the index. Damn it, I hope that doesn't happen. But let's say that ever happens. Hey, I'll still feel pretty happy, assuming I don't lose money. Because I mean, I feel a lot smarter. It's just a more fulfilling way to live. So I'm going a bit on a more philosophical answer here instead of a more investing answer. But that's actually the way I see it. Yeah.
How about you, Eugene? I know you've beaten the street in past. That's your book is about. But it's these kind of drawdowns, these kind of a pain, kind of a says that it's not that it's going to happen, but it's a point of view. You start seeing things in a different, like it's like life. You start taking things for granted, and when some shit hits you, then you start appreciating the small things.
Rajiv, I think you brought a really good reflection to this discussion, right? Especially, I think last year, for example, I underperformed the market, and the question is, what's going to happen next? I think the way to think about it is that the average is very hard to beat. Close to 80-90% of portfolio managers underperform the S&P over a 5 to 10 year period, and that is the undistorted truth, right? But I think where we have an edge is this. There are always power laws that exist in all games. And in investing, the very small percentage of companies account for the majority of the returns. That is extremely clear, be it the US market, be in the global market. Basically, Best and Binder had done two very good papers on those. I think that's extremely clear. So the way to think about it is how to find these winners and to really just hold them for the long run. That's really just the investing secret, right? I think it's just trying to find out what are the traits that the companies, as Max really blends in this very nicely. We invest in businesses not for returns. I invest in businesses because I want to invest in the best businesses. They're really changing and shaping the world for the better, and I'm playing that role and doing so.
It's a catalyst kind of role.
Catalyst, exactly. It's a catalyst for change. If I can get more people to exactly invest in the same way, and more companies are out there doing exactly the same thing, and they are also profitable and reinvesting all the profits and becoming even more innovative, the world is going to go into a very good direction. I think that's really what we're trying to do. And if we can all do this, we can all benefit together. We can all grow together. And I think that's extremely good. So I think it's just what we know, that I know what a losing company looks like. I know what a winning company looks like. So the question is, can we hold it for the long run and just hold it, right? And I think really the way to think about it in investing, this brings such a beautiful one, which I was a recent article that I wrote. A game, you know that a game basically, how to say, if you try to do a coin toss, you never know whether you win or lose. But a real game of skill is a game that you can intentionally lose. And I think in investing, I don't know if I can intentionally lose or win in one day, in 1 week, in 1 month, or even 1 year. But I would like to think that I can intentionally win for over a much longer period, which I think that's because it's a game of skill. Because in the short term, there's just so much noise. And I think really that's what we're trying to differentiate here. And that's really how to think about it. Like you tell me, if I want to lose the game right away, I will just do one stock, I will leverage it 100 times. All I need is the market to draw down 1% and I'm wiped out. That's how simple it is. I can lose all my portfolio right away. But I don't, right? You diversify, I don't take leverage. I know my portfolio will never go down to 100, go down to 0. So I think
leverage is an important thing in these times. Huh?
In these times,
when the bull market is there, you take leverage and you say, oh, you pay 1% and you make you can think you're a genius. And leverage in this time can bite you like anything. I think the last questions for both of you. What one company, I know, Eugene, you have 85 companies to look after. And Max, you have 7 or 8 companies to look after. Tell me what company, Max, you are looking for the earnings, you're most excited or most worried in this environment? Not excited, let's say I'm talking about the good news.
Yeah.
What company you're really looking for? And then Eugene, I know you 6 a.m. updates, I'm still waiting, Max and you. So then you talk about one company, what you are looking for, and then we close the discussion.
Okay, so your question is, because I got a bit lost. Is it excited or is it worried?
No. So what I'm saying, when you're excited, it means that you have most money in it, and at the same time, it will make you worry also if it doesn't perform. So let's talk about your top. Which one you're looking for?
Okay.
Which makes a difference to you.
Got it. I need a bit more time to think. Eugene, you can, because Eugene got more to choose from. So Eugene, you can go first, man. 85. Yeah.
I try to do a quick summary, right? So I think one of the companies that I really like is Tesla. I think
same as me.
a lot of people know it, but I think really you got to think about it that the market is extremely big. You look at the auto market, it's probably one of the largest markets in the world. It's probably in a couple of trillions, right? We sell close to 100 million cars a year. And the way to think about it is that the move from what we call internal combustion engines right now, which is ICE, to battery EVs is going to take at least 2 to 3 decades. It's a 20 to 30 year play. And right now, we're just starting now. We are really just starting out. Our penetration rates for EVs are low single digits, right? 5-6%. You might have it higher in China, have it higher in Europe, but it is really just starting out. And I think there won't be a winner takes all, but I believe it will be a winner that will take most of the profits, just almost like Apple, right? Apple makes like 10, 15, 20% of the entire smartphone market, but makes close to 80-90% of all the smartphone profits. So I think it is where the niche is. You're able to own the entire value chain. You're able to have the software stack. You're able to have the full self-driving. And that basically, the full self-driving, just imagine, they've spent so many years of R&D already on it. And when everyone's going to pay $12,000, that basically flows down right through to the bottom line as free cash flow. That you don't see that being priced in yet, but once that comes in, suddenly the profitability of a car just jumps straight through the roof, and it's unseen.
I think it's very efficient. It's becoming, if you see the operating expenses, they're kind of same, and I think
exactly. And the interesting thing about Tesla is that I won't be surprised at some stage it'll be like Apple, like most. Apple has a negative cash conversion cycle, which means when you're buying an Apple phone, you're paying for that Apple phone up in advance. They send it to you in a couple of days, but you know what? They're getting like 30 to 60-day payment terms from the suppliers. So they actually, for every phone you're buying, they're getting negative cash from. They're getting cash upfront. They're getting free financing from the suppliers. So I think the way Tesla, if you see their cash conversion cycle, the matrix are already improving in the right direction. So clearly they are getting that bargaining power from the suppliers, and all the matrix are all moving in the right direction. If I would say best, don't look at the quarter to quarter, look at the trailing 12 month. They're all moving in the right direction. And you add in autonomous vehicles, robo-taxis, where they get 1/3 take rates. I think that is going to be an extremely powerful view of where I see the future is going to be. So very excited. I think very excited and see how it's going to be. It will take time. I don't think we are there right now in terms of full self-driving. I've driven it for 2 weeks to really try to understand that. I don't think we're any time close to that. But I can tell you, they have the most number of cars that are out there learning, far larger. So right, I think Elon Musk basically told Katie Wood, right? I have the most number of miles. I think like basically sum of all of my competitors combined by 100x. That's the amount of machine learning they have already in their model that is way ahead of the pack, right? So I think if where my money is, they'll probably be the one. Hopefully, they can continue to keep delivering.
And the earning is today, right?
And make the world a better place. And that's what I like to see.
Awesome. And Max, you sold Tesla, Max. You had Tesla and you sold it. I know that, right?
Yeah. Through our lunch conversation.
You bought Peloton, is it?
Yeah, exactly. Damn. Okay. Actually, to be fair, I'm really rooting for Tesla, and the reason I sold it because I don't really understand the company, but I really like the vision in a sense of really like trying to transition the world to renewable energy, right? Okay. But anyway, I think for me, I'm a bit weird, right? So I'm actually rooting for these bunch of companies that I don't own, but I'll share what I'm rooting for that I own later. I'm actually rooting for China. I know it sounds freaking odd. Okay, so I don't own any Alibaba or Tencent, but I'm rooting and actually excited. So I do follow their earnings, though I don't own them. For one simple reason, I think after 2021, the stocks have all plunged from like the highs and everything. And of course, granted, I think Alibaba's recent quarter, they had a slowdown in the GMV, was it, or the revenue that's why they got sold off, whatever. But I'm excited because of one thing. I think it's extremely dislodged from the real fundamentals. Like you have a company, maybe we don't use Baba, let's use Tencent. Like you have a company that's one of the top gaming leaders in the world, and gaming is a very high margin business with kind of like a VC arm that is extremely has been proven to have a good track record, and that's totally mispriced right now. And I think it's still in a country that has like it is still growing and developing with a very big population size. So I'm actually very excited for China and the next few years in terms of the price where it is now and where it could go. But of course, I don't own it because of just the growth doesn't excite me from a percentage wise. So of course, then to answer your question, what I own that I'm excited / looking closely like a hawk is of course C Limited. So no surprises there. I think how we could go this year for me, it's really, if I honestly touch my heart, I hope I'm wrong. I think it will probably be a stagnant year. So I did some short-term analysis, which, like I mentioned, short-term means nothing to me, but I just do it because I want to know this year how my money is going to be moving. So at least I know what to expect and I don't have like misblown expectations. So the reason I said it is because number one, Garena / Free Fire is slowing down. So I know on Twitter, the last few weeks, there have been a lot of hype regarding Free Fire Max coming in strong and making a dent in Garena's numbers. I'm skeptical, honestly, because if you look at the Q3 earnings called the management, which is the COO, right, Eugene Ng, she already mentions that Free Fire Max, it's still in the stage of actually growing that user penetration and engagement. So don't expect so much monetization. Granted, C Limited is known for like sandbagging and being very coy about it, but I'm not expecting much there. And I went to do some like forward numbers as well. GMV for Shopee, if it grows at the same rate like it grew for the last few years. So Shopee GMV every Q3 to Q4, because Q4 is a seasonal jump, right? For 99 and then there's 11, it will grow by 20% per quarter from Q3 to Q4 over the last few years. It grew by 22%, 28%, 22% about there, right? And then so let's just assume this year from Q3 to Q4, it grows also 20% plus quarter on quarter, which I think it's tough given how big the base of GMV is right now. But let's assume they do that. Even from that point of view, the year-on-year growth for GMV is slowing down and decelerating. So just from that point of view, I'm not expecting much pops or surprises to the upside from a price perspective. I still love the company from execution point of view. And so I'm watching it closely. If Garena slows down, which it could, then the stock price might stay stagnant or could even tank further. Ouch. But yeah, it's just something that I've researched quite a fair bit on. So I'm actually okay sleeping and I don't lose sleep over these concerns. Yeah.
Well, I think both Tesla and C Limited are very dear to me as well.
You own.
I have some invest. Let's see. I mean, obviously Tesla is a life-changing, or what do you call the planet-changing company, and C is doing its bit as well. Both are great companies, guys. So, gentlemen, thank you for your time.